In this week's market update, safe havens are back in favour with Ukraine on the brink. Red hot inflation stokes interest rate fears. The 2-year anniversary of the pandemic plunge approaches, and how is earnings season panning out? Markets finally focused on Ukraine at the start of this week, having shrugged off the threat of a Russian invasion. Even as the rhetoric intensified, investors finally caved into speculation at the weekend that military action is imminent. Stock markets picked up on US weakness at the end of last week, with falls across Asia and Europe on Monday. Investors moved into safe havens with bonds, oil and gold in favour. Although Ukraine is not a member of NATO, reducing the risk of the US and its allies being drawn into a European war, markets have focused on the likely economic impact of Western sanctions on Russia. In particular, sanctions could have a big impact on energy, food and metals prices. All of these are already rising, so the Ukraine situation exacerbates an already difficult inflationary picture. The price of natural gas rose another 12% on Monday, while the cost of a barrel of oil rose ever closer to $100. Bond yields, which have been rising on expectations of higher interest rates, have retreated as investors moved into the relative safety of safe government-backed securities. Rising prices go hand in hand with lower yields in the bond market. This flight to safety has not included either Russian or Ukrainian bonds, however, with prices hitting their lowest of the year. Ukrainian debt is trading at less than 80 cents on the dollar. Gold, which is often viewed as a safe haven in times of geopolitical and financial uncertainty, was up nearly 1% on Monday at $1,857 an ounce. It does, however, remain well off its recent all-time high of over $2,000 an ounce. The worsening political situation on Europe's eastern border adds to growing fears in financial markets that a damaging interest rate hiking cycle is about to start. Talk at the weekend focused on two previously unexpected possibilities. First, that the Fed's first interest rate hike could be 50 basis points or half a percentage point rather than the more usual 25 basis points or quarter percentage point rise. Second, that the Fed may even move before its next scheduled rate setting meeting in March. If it were to implement an out-of-cycle rate hike, it would be the first such move since 1994 and before that 1979. It would be extremely unusual for the Fed to act in a way that would signal that events were moving out of its control. Already, the expectation only a few months ago that there would be only 1 or 2 rate hikes in 2022 in America has morphed into a full-blown tightening cycle that could see as many as 7 rate hikes this year. Fears intensified last week when the year-on-year inflation rate rose from 7 to 7.5%. This was the fastest pace of price rises for 40 years. The last time inflation was this high was in February 1982. The yield on 10-year government bonds rose above 2% for the first time since August 2019 in response as investors positioned themselves for a more robust response by the US central bank. Despite this, there remains a significant mismatch between what the Fed is telling us about the future direction of interest rates and what the financial futures are indicating. The Fed funds and Eurodollar markets are still pointing to US interest rates rising not much higher than 2% before peaking, which would leave US monetary policy extremely accommodative by historic standards when compared with both inflation and what is considered a neutral interest rate. Despite all the hawkish noises from the Fed and inflation scare stories in the media, interest rates are expected to peak in 2023 at around 2.25% and then gradually to fall back to around 2.1%. For this to happen, one of 2 scenarios needs to unfold. The first possibility is that the Fed manages to talk the markets into doing the tightening for it, rising bond yields, tame inflation, and take the pressure off the central bank to rein prices in. The second scenario is that the Fed raises rates hard and fast and essentially overdoes it, as it did in 2018 when it was forced into backtracking on its planned tightening cycle. it goes without saying that the first possibility would be better for the markets. The second would probably involve a more serious correction in equity markets than we've experienced so far this year, when the S&P 500 is down 6% to date and the Nasdaq off by about 10%. The good news from the markets is that sentiment has already shifted. The ratio of positive to negative bets on the future direction of shares, the call to put ratio, is back as low as it's been at any point since markets fell sharply at the start of the pandemic. Investors are also starting to buy the dips, especially the so-called insiders who are buying shares in their own companies and are often a good guide to when the market is oversold. Finally, valuations are now back down to close to where you would expect them to be on the basis of the relationship between bond yields and the price to earnings ratio. The derating that typically happens at this stage of the earnings cycle may have largely run its course. That, of course, depends on how well corporate profits hold up this year. Over the last 3 months, expectations for earnings growth in 2022 have fallen from nearly 9% to about 7%. So forecasts are still heading the wrong way, but only marginally. The combination of earnings growth and steadier valuation multiples still points to a positive outcome for shares this year, even if it suggests that investors are right to have reined in their hopes. That moderation of expectations comes as the market prepares for the second anniversary of the pandemic plunge between February and March 2020. It's been a remarkable period for markets from which investors can draw some important tactical lessons about handling market volatility. If you look at a 5-year chart of the FTSE 100, for example, you'd be tempted to ask, pandemic, what pandemic? The UK benchmark index is back at exactly the level it stood at in February 2020, when news of the coronavirus first started to be taken seriously by investors. The US market is about a third higher than its pre-pandemic peak. But that's not what it felt like 2 years ago. On Friday, February the 21st, 2 years ago, the FTSE 100 closed at 7,404. It had been as high as 7,675 in the middle of January. But by the 23rd of March, just over 1 month later, it had fallen briefly to close under 5,000. It was an explosive bear market which shook investors, reminding them of the financial crisis in 2008 and the dot-com bust 8 years earlier. But what few investors realised at the time was that 2 years later, the FTSE 100 would be 50% higher. In the case of the US market, the S&P 500 would double from its low point of 2,237 on March the 23rd. Even after the recent correction, the US benchmark has risen by around 100%. Hindsight's a wonderful thing. As economies went into lockdown and whole economies essentially shut down, it was a brave call to think that things would bounce back as quickly as they did. But the past 2 years have shown that the time to be most bullish about markets is when the outlook appears most uncertain. A second lesson to learn from the markets recently is that there are always opportunities. The FTSE 100 may have underperformed the US market over the 2-year period, but since the start of this year, it's provided some ballast in a well-diversified portfolio. Since the start of the year, UK shares have risen 4%, while their US counterparts have fallen about 7%. Diversification and sticking with it through the market's ups and downs, good lessons to bear in mind as Russian troops mass on the border of Ukraine.